Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
Glad to be here for this one.
Yeah, we have an absolutely massive stack of source materials to get through today. I mean, if you've been glancing at your screens this week, you know the picture is just, it's intense.
Oh, completely.
We've been pulling raw data, market analytics, on-the-ground reporting from CNBC, Bloomberg, Reuters, and a Wall Street Journal. And our mission for this deep dive is to basically synthesize all of it for you.
Right. Think of this as your shortcut to being the most well-informed person in the room today.
Exactly. Because we are tracking this this incredible convergence of global events right now. We're talking about a 7-day war in the Middle East that is fundamentally rewriting the rules of global shipping and wealth.
Practically overnight.
Yeah. And at the same time, we're watching traditional financial safe havens just completely break down right when investors actually need them the most.
Which is wild to see in real time.
It is. And on top of all that, there's a massive feud erupting between the Pentagon and the world's top AI companies. So it's a highly complex global puzzle, but we are going to put the pieces together for you.
It's a puzzle where the pieces keep changing shape while you're holding them, really. What's fascinating here is how deeply interconnected every single thread is.
Yeah, you can't isolate them anymore.
You literally cannot look at the tech sector today without understanding global geopolitics. And you can't understand the bond market without looking at, container ships. The isolation of these sectors is just a complete illusion now. Everything is bleeding into everything else.
So let's start with the primary catalyst driving all this sheer chaos. We are entering the 7th day of this Iran-U.S. conflict, and the spillover effects are moving fast.
Very fast.
So we look at the energy markets first. Crude oil blew past the $80 per barrel threshold this week. The latest Reuters data shows Brent crude specifically topping $86 to $87 a barrel. And the rhetoric on the ground suggests this is not just some short-term spike. Iran's foreign minister, Abbas Araqi, is on the record stating flatly that they are, quote, not asking for a ceasefire.
Which is the clearest signal possible to the energy markets that these supply disruptions are going to be prolonged.
Yeah, there's no quick fix coming.
Exactly. When diplomatic off-ramps are publicly and officially rejected like that, the market instantly pivots. It stops pricing in a temporary hiccup and starts pricing in sustained structural instability.
And back here in the U.S., the political maneuvering around this conflict is equally intense. The House of Representatives just held a highly scrutinized vote on a war powers resolution.
Right, the one meant to rein in President Trump's military operations regarding Iran.
Exactly. But the House actually rejected it. The final vote came in at 212 to 219. And to give you the exact breakdown from the reports, 4 Democrats joined the Republicans to vote against the measure, while 2 Republicans crossed the aisle to join the Democrats in voting for it.
It's a fundamental constitutional debate playing out in real time.
It really is.
Those supporting the resolution argue that the Constitution explicitly vests the authority to declare war in Congress, meaning these kinds of operations require congressional approval. But with the measure failing, the administration's military operations proceed without that specific legislative check.
Right.
It's just a critical domestic political layer added to an already volatile international crisis.
It is, and the shockwaves from that crisis are completely redrawing the economic map of the Middle East. I was reading this Wall Street Journal report, and this detail was staggering. Look at Dubai.
Yeah, that was a huge takeaway.
Dubai has spent decades and billions of dollars engineering itself into this ultimate tax-free global wealth hub. It was supposed to be the modern-day Switzerland of the Middle East, right? A purely neutral, safe space for the ultra-rich.
Right.
But the reporting notes that this status has been effectively shattered.
Because wealth, above all else, demands physical safety. It turns out a 0% tax rate doesn't mean much if your luxury cabana is in the path of a projectile.
Exactly. We are seeing reports of projectiles hitting civilian and tourist spaces. Specifically, the 5-star Fairmont, the Palm Hotel, and the Dubai International Airport. So the wealthy are scrambling for the exits. On top of that, the UAE is reportedly mulling over freezing Iranian assets.
That's a massive shift in their neutral posture.
Huge. And then you look at the supply chain side. Maersk, which everyone considers the absolute bellwether for global trade, has outright suspended two of its key shipping services because of the conflict.
Let's walk through what that actually looks like on the ground, because it is profoundly disruptive to you, the listener. It's not just a distant geopolitical event playing out on a news ticker somewhere.
Right, it hits home.
When a global shipping giant like Maersk halts services, and when projectiles are shutting down major international transit hubs, the friction in global trade skyrockets instantly.
Ships have to be rerouted entirely.
Exactly. Ships are rerouted, insurance premiums absolutely explode, and transit times double. And who pays for that friction?
The consumer.
The consumer. It shows up in the cost of imported goods, and most aggressively, it shows up via energy costs at the gas pump and in your home heating bills.
Okay, let's unpack this.
Yeah.
Because if everything feels unstable and inflation is threatening to spike from these energy costs, the natural instinct for anyone managing a portfolio or just watching their 401k is to run for cover.
You look for safety.
You look for safety. But Bloomberg released a startling report today showing that the trusted financial safe havens are completely failing.
That's crazy.
It's like spending a fortune to build a state-of-the-art storm bunker in your backyard, only to realize the roof leaks exactly when the Category 5 hurricane finally hits.
That's the perfect analogy. The traditional Wall Street playbook for a market panic is simple. You buy U.S. Treasuries, you buy the Japanese yen, you buy the Swiss franc, and you buy gold. You lock your money in those vaults and wait out the storm.
But right now, that entire playbook is burning.
It's totally burning.
The numbers are totally counterintuitive. Wait, so if I'm looking for a safe harbor during a literal war, why wouldn't I just buy gold? Doesn't gold usually skyrocket when geopolitics get this messy?
Normally, yes. But here is the catch with this specific crisis. Gold is actually down 3.5% this week.
Wow.
And the reason is intrinsically tied to what is happening with the U.S. dollar and interest rates. Gold pays you zero interest. So when the U.S. dollar is surging, and according to Bloomberg, the dollar is the only major asset actually rallying right now. And when interest rates are expected to stay high, gold suddenly looks very unattractive compared to just holding cash that yields an actual return.
Which brings us to the bond market, which is acting just as strange. U.S. 10-year bond yields jumped 20 basis points.
That's a huge move.
Yeah, for anyone who doesn't track bond math daily, a 20 basis point jump in a short window is a massive move. It's the biggest jump we've seen since the tariff drama back in April.
Yep.
And we are seeing swaps now pricing in just 1 to 2 quarter-point rate reductions from the Federal Reserve.
And if we translate that jargon into conversational impacts, if you look at interest rate swaps, which is basically Wall Street placing its betting slips on what the Federal Reserve will do next, traders are throwing in the towel.
They don't think help is coming.
Right. They're realizing the Fed can't ride to the rescue and cut rates to save the economy if inflation is surging again.
So why is inflation surging?
Yeah.
Because of the oil shock we just talked about.
Precisely. If we connect this to the bigger picture, it explains exactly why your financial storm bunker is leaking. The traditional market playbook works when a crisis causes a drop in consumer demand. When demand drops, inflation cools, central banks cut interest rates, and assets like bonds soar in value.
But this crisis is entirely different.
Entirely. This is a supply-side shock.
We are staring straight down the barrel of 1970s-style stagflation. Prices at the pump are going up because the war is threatening the supply of oil and gas. But at the same time, economic growth is stalling out.
Exactly. And when inflation spikes due to soaring oil prices, the demand for U.S. debt drops because that inflation eats away at the bond's returns.
Right.
That's why the 10-year yield jumped. Remember, bond yields move inversely to bond prices. As investors sell off the bonds, the yield has to go up to attract buyers. Christoph Reiger, the head of rates and credit research at Commerzbank, summed it up perfectly in the reporting. He said, risk-off is not what it used to be.
Even the Japanese yen is failing. It's down 1% against the dollar. Why is the yen losing its safe haven status?
Again, it all traces back to energy mechanics. Japan is an island nation with very few natural energy resources. They rely on the Middle East for over 90% of their crude oil imports.
90%.
Over 90. When the Middle East is engulfed in conflict, Japan's entire economy is disproportionately threatened compared to the U.S. The typical safe assets act completely differently when the root cause of the crisis is an energy shock.
Here's where it gets really interesting, though, because this wartime environment isn't just affecting oil and bonds. The geopolitical tension is bleeding directly into Silicon Valley. I was reading this quote from David Chen, a top tech banker at Morgan Stanley, and he stated that this is now, quote, wartime, not peacetime for software.
That is a stark pivot in terminology for the tech sector. We are used to software companies talking about frictionless growth, disrupting legacy industries, changing the world. We're not used to them talking about being on a wartime footing.
Right, what does that even mean for a software developer?
Exactly.
Well, it's not just a metaphor anymore. There is a massive, tangible clash happening right now between the titans of artificial intelligence, specifically Anthropic and OpenAI. According to the reports, the Department of Defense has essentially blacklisted Anthropic.
Wow.
And it all stems from disagreements about how the federal agency can use Anthropic's AI models.
It's fascinating because this isn't about the tech not working. It's a profound collision of ideology and federal power. You have the Pentagon wanting to utilize the most advanced AI systems in the world for national security and defense logistics.
Yes, sir.
But you have these AI companies that were built by researchers with very strict internal ethical charters about how their intelligence can be deployed.
And the fallout is getting messy. Anthropic's CEO is vowing to challenge this supply chain risk designation from the DoD in court.
Which is a huge escalation.
It is. Meanwhile, Microsoft, which obviously has massive investments across the AI space, they had to step in and publicly confirm that Anthropic's products remain available to their corporate customers. They're clearly trying to calm the waters so enterprise clients don't panic.
Damage control.
Yeah. But then OpenAI CEO Sam Altman took a very direct public swipe at Anthropic over this exact issue. He stated that it is, quote, bad for society if companies start abandoning their commitment to the democratic process just because some people don't like the person or people currently in charge.
This raises an incredibly thorny question for you as an observer or an investor of this space. What happens when tech giants, who control the foundational infrastructure of the future, are forced to pick sides in global conflicts?
It's a collision course.
We are watching companies try to balance the pursuit of massive, highly lucrative government defense contracts with the ideological boundaries of their own employees.
And the employees are not staying quiet about it. The reporting notes that activists are literally outside OpenAI's offices using sidewalk chalk to write messages that say, "What are your red lines?"
Sidewalk chalk.
The irony is incredible. You have companies building artificial superintelligence that could alter the course of human history, and the employees are out on the pavement protesting with Crayola sidewalk chalk.
It highlights the human element inside these algorithms, but from a market perspective, how do you price in ideological risk?
You really can't, and that's exactly what Jim Cramer pointed out. He noted that the market is stuck in limbo with these tech stocks. He specifically pointed to the semiconductor companies, the ones building the physical chips that power all this AI, like NVIDIA and AMD.
Right.
Their stocks dipped heavily just on rumors that the U.S. government might block certain chip sales to specific regions or entities.
Let's break down why that matters so much. If the government steps in and dictates who can and cannot buy these chips based on national security, the total addressable market for these companies shrinks overnight.
It just evaporates.
Cramer noted exactly that. Nobody wants to touch semiconductor stocks if their potential customer base is about to get clubbed by government regulations. If a company can suddenly only sell to half the world instead of the whole world, their valuation has to drop.
Makes sense.
It adds a massive layer of sovereign risk to what everyone previously viewed as a pure, unhindered growth play.
That same tension we are seeing with AI, the government stepping in and dictating who can do business with whom, is exactly what's playing out on the global trade map right now with tariffs. The administration is aggressively maneuvering resources and economic levers like it's a giant game of global chess.
Oh, absolutely.
Let's look at the legal battles surrounding the tariff regime. New York Attorney General Letitia James, along with 23 other states, is officially suing to block President Trump's global tariffs.
And this comes right on the heels of the Supreme Court actually striking down his previous effort to implement these tariffs.
Right.
The financial and logistical implications of this legal battle are massive. Why? Because the Trump administration is actively looking for ways to keep the revenue they already collected from those tariffs that were subsequently ruled illegal.
Even though they previously told the courts that issuing refunds would be easy.
Exactly. It's a deeply complex legal and economic tangle. How does a government refund billions of dollars in supply chain tariffs when the costs have already been passed down to the end consumer? It's almost impossible to unring that bell.
But the global maneuvering doesn't stop with domestic lawsuits. Remember all the oil supply worries we discussed earlier regarding the Middle East?
Yeah.
Because of that pressure, the U.S. just issued a 30-day waiver to India, allowing them to resume buying Russian oil. What makes this so striking is that just last month, the U.S. had hit India with a severe 25% penalty specifically for buying Russian crude, and warned them they would reinstate that penalty if the buying resumed.
And now a waiver.
And now suddenly a waiver.
It is the ultimate display of pragmatic geopolitics. Geopolitical priorities shift instantly when the fundamental supply of global oil is threatened. Penalizing India made strategic sense to the administration last month when they wanted to pressure Russia.
But not anymore.
Right. This month, with Brent crude surging toward $90 and the Middle East in an active conflict, ensuring that the world's third-largest oil importer has access to supply, even if it's Russian supply, suddenly takes precedence over the previous penalty structure.
You just can't squeeze it from both ends.
You can't squeeze the global oil supply from both ends without causing an economic collapse, so they granted the waiver.
We are seeing that leverage aggressively used elsewhere, too. U.S. crude futures actually rose over 1% after President Trump ordered a total and complete block of all sanctioned oil tankers entering or leaving Venezuela.
More supply constraints.
Exactly. And looking ahead, the administration is already signaling its next target. Trump hinted strongly that the U.S. will turn its focus to Cuba next. He actively took credit for, quote, choking Cuba's economy to force a deal.
Right.
His exact quote from the reporting was, "How long have you been hearing about Cuba, Cuba, Cuba for 50 years?" And that's one of the small ones for me.
It's a stark reminder that while the broader market might be hyper-fixated on the Middle East conflict and the AI drama in Silicon Valley, the administration's trade and sanction policies are moving on multiple fronts simultaneously.
It's a lot to track.
From waiving penalties on India, to blocking tankers in Venezuela, to signaling new economic pressure on Cuba, the active use of blockades and tariffs is fundamentally altering how goods and energy move around the planet.
So what does this all mean for you? We've covered a massive amount of heavy macroeconomic shifts today. But as we look ahead to Friday's market opens, how is all of this going to actually land? The big domestic event everyone is watching right now is the impending jobs report.
Because regardless of global volatility, the labor market remains the ultimate domestic anchor. If people have jobs, they spend money. If they don't, the economy contracts.
The traditional Dow Jones consensus model is calling for 50,000 jobs who have been added. However, some experts on CNBC have been warning that the underlying data is weak enough that the number could actually come in negative.
Which would be a shock.
Yeah. But there's a really fascinating counterindicator here. If you look at the prediction market, Kalshi, which, it's worth noting, was highly accurate in predicting last month's numbers, they currently have 58% of people placing real money bets that the report will actually beat the 50,000 expectation.
That divergence is always interesting to watch. Prediction markets often capture raw sentiment and subtle, real-time data trends that traditional, backward-looking consensus models might miss.
True.
If the jobs number does beat expectations, it could provide a much-needed domestic psychological boost amidst all this global volatility. If it comes in negative, though, it will dramatically amplify those stagflation fears we broke down earlier.
And internationally, we are actually seeing some surprising resilience despite the very scary headlines.
Yeah.
Look at the South Korean market, the Kospi. It has definitely been seeing some wild volatility due to the macro environment. But market experts, specifically Kieran Poon of Aberdeen Investments and JP Morgan's Recede, are arguing that the underlying fundamentals in South Korea actually remain incredibly strong.
That's interesting.
They specifically pointed to the memory chip Market Dynamic Random Access Memory, or DRAM. Supply dynamics there remain incredibly tight, and they believe that tight supply will support Korean chip makers straight through this current wave of geopolitical volatility.
That is such a vital point to remember as you navigate all this information. While the daily headlines are driven by fear wars, Pentagon blacklists, shifting tariffs, the institutional drivers of the global economy often endure straight through the noise.
The demand doesn't just disappear.
Exactly. The global demand for DRAM memory chips isn't going to vanish because of a tariff dispute in New York or a delayed rate cut by the Federal Reserve. The structural baseline demand for computing power is a foundational reality of the modern economy, and it provides a floor for these specific sectors.
It really is a massive amount of data to process. To recap what we've synthesized today, we are watching a kinetic Middle East conflict physically reshape supply lines and shatter the illusion of safe global wealth hubs like Dubai.
Right.
We are experiencing the paradox of trusted financial safe havens like goals and U.S. treasuries springing leaks right when the economic storm hits. We're seeing the tech sector forced onto a new wartime footing, trying to balance lucrative Pentagon contracts against sidewalk protests from their own employees.
And the tariffs.
Yes, and all around it, a constantly shifting global chessboard of tariffs, oil waivers, and blockades stretching from India to Venezuela.
It requires a completely new framework for how you analyze the news. The old rules simply do not apply to this convergence of events. I'd leave you with this final thought to mull over as you watch the markets open. If the very definition of a safe haven is fundamentally changing before our eyes, if treasuries and gold no longer offer the automatic shelter they once did during a crisis, how will we need to reshape our core understanding of risk in a world where data, artificial intelligence, and physical energy supplies are completely intertwined?
That is a big question.
The old maps simply don't match the new territory.
That is exactly the kind of question we need to be asking right now. We'll see you all Monday morning with new headlines from major financial magazines.